Happy New Year, everyone, and thanks for joining us for this special edition of AIADA's AutoTalk. I'm your host, Rachel Soleimani. For any new listeners, anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome Kerrigan Advisors founder and managing director, Aaron Kerrigan. If you've listened to a Kerrigan webinar in the past, you'll know that Aaron has a theme for every presentation. I got to take a sneak peek at this one, and I know you'll all be excited for it. So Aaron, I'll let you take it away.
Thank you, Rachel, and Happy New Year, everyone. Thank you, as always, AIADA, for inviting me to kick off what is sure to be a momentous and exciting year in auto retail. We'll be going over our firm's predictions and expectations for the buy-sell market of 2025. Before we get started, I am proud to share that Kerrigan Advisors achieved an important milestone in 24, celebrating 10 years in business, leading the industry in sell-side advisory with the completion of over $9 billion of transactions representing 278 plus dealerships in almost every major U.S. market. We attribute our firm's success to our team model, which is very distinct from the brokerage model common in our industry. With each client engagement, our entire team, pictured here, works together to ensure our clients' personal and financial goals are achieved. In our view, dealerships are far too valuable to be sold any other way. Kerrigan Advisors is also the leading sell-side advisor to the most valuable import franchises, including having represented on the sale of more Toyota dealerships than any firm in the industry. Recently selling Cowboy Toyota in Dallas, Texas to the Kona Group in the fourth quarter. And just this week, yesterday, in New Orleans, of all places, we sold a Toyota dealership on behalf of the Bone Brothers. Speaking of New Orleans, I am using a New Orleans theme to my presentation today. I thought it only appropriate as NADA kicks off next week, and I certainly see similarities between the frenetic activity on Bourbon Street and the 2025 buy-sell market, which could surpass 2024's new record. Through the third quarter, Kerrigan Advisors registered 330 transactions representing a record 544 franchises, a 93% increase from the pre-pandemic averages. Now, as we begin to tally the fourth quarter results, we expect 2024 will be another all-time high for transaction activity, and we don't see this activity abating anytime soon. The market's buoyancy is driven by several factors, starting with buyers' positive outlook on 2025 and the years beyond. Since the election, Kerrigan Advisors has observed a notable shift in industry optimism from the leading consolidators, evidenced by the 29% jump in the Cox Market Outlook Index measuring dealer expectations for auto retail post-election. Kerrigan Advisors' 2024 dealer survey of more than 600 dealers, the largest of its kind, likewise further supports the industry's positive growth bias, with nearly 50% of dealers surveyed seeking acquisitions in the next 12 months. Now, one of the driving forces of industry consolidation is the strength of buyers' balance sheets, especially the largest dealership groups with diversified franchise portfolios. As an industry, Kerrigan Advisors estimates we have amassed over $250 billion of profits since the pandemic, nearly 3 times the pre-pandemic level. With average dealership earnings now normalizing, buyers feel more confident in our experience in their blue sky valuations and pro formas, and thus are leaning further into growth. As you can see here, average dealership earnings are starting to flatten on a quarterly basis, enabling buyers to apply their blue sky multiples to current trailing 12 months earnings when valuing a dealership. This is much preferred to the way they were having to do it, the buyers, during the pandemic years when there was a lot of guesswork as to what normalized earnings might be. Today, most feel comfortable using current earnings. Also, many dealer groups believe scale, particularly in a locality or region, will be a key profit differentiator in the future. So growing their immediate market share is a primary goal, as they believe it will ultimately enhance the value of their group long term. These buyers are also largely optimistic about the future profitability of most of their business segments. Of course, with the exception of EVs. Except for EVs, the majority of dealers expect all their other business lines to be positive contributors to dealership profitability over the next 12 months, according to our survey. And most feel that EVs with the new administration will not be as much of a mandate on the OEMs. And Wall Street, by the way, seems to be equally as optimistic. The Kerrigan index of the 7 publicly traded auto retailers was up 54% through the election and remains very close to an all-time high, resulting in the public's blue sky multiples rebounding to their highest level since the pandemic, the peaks that they achieved in the pandemic. Now, there is often a 2-quarter lag in U.S. dealership acquisition spending by the publics after their stock price appreciates, due, of course, to the time required to complete an acquisition, which is typically 1 to 2 quarters. The recent rise in public valuation multiples may predicate an increase in U.S. acquisition spending in 25, given more acquisitions are now accretive to their earnings. I do want to point out that the high multiples you see in 20 in the fourth quarter in 20 and the first quarter in 21 are partly reflected by the very low earnings in that period. So those are really an anomaly. Today's multiples are very, very strong on a historic basis for these companies. Now, part of the reason we would expect more acquisition activity by the publics is the fact that they are sitting on a near record level of liquidity, $7.1 billion at last count at the end of the third quarter. 64% more than they had on their balance sheets before the pandemic. But as significant as the public spending capacity is, the private sector still leads the buy-sell market, acquiring 95% of sold franchises through the third quarter of 24. Yes, the publics represented just 5% of franchises acquired, and they typically, frankly, are around 5 to 10% in range. Our industry remains largely private. Small private groups continue to dominate the buy-sell market at 63% of the buy-sell market share. However, the largest private consolidators are quickly gaining ground, seeing their buy-sell market share more than double in 3 years to 32% in 2024. Now, most notably, Holman's acquisition of Kerrigan Advisors' North Carolina client Leith represented about 30 franchises acquired in one transaction by a private dealer group, one of the largest private acquisitions on record, and that's certainly having an impact on this number. Last year, the largest private groups grew their share of the buy-sell market by 66% in the first 9 months, whereas the smaller groups saw their share decline 17%. We believe this is largely driven by these groups' disparate access to capital. We talk about this in our most recent Blue Sky report. Part of the challenge that smaller groups are facing today is that lenders are often seeing them as an increasingly risky client. The decline in the NADA average dealer's current ratio and return on equity, along with the rise in days supply of inventory, particularly for the weakest franchises, is negatively impacting the risk profile of smaller groups, reducing lenders' interest in financing their acquisitions and extending additional floor plan. Financial institutions have a growing bias to increasing their credit exposure to the largest diversified dealer groups, whom they believe will continue to grow market share and thus are the right horses to bet on. We expect this trend will continue in 2025 as the largest groups gain increasing share of the auto retail market. The top 150 dealership groups in the U.S., including the publics, have increased their industry market share by 5% over the last 5 years, effectively adding 1% a year. reaching a total of 30% of industry revenue in 23. At this rate, in just 20 years, the top 150 dealership groups will represent the majority of industry sales, potentially a consolidation tipping point when it will become increasingly difficult to compete for smaller dealers. Now, while 2043 seems like a long way away, Kerrigan Advisors finds that dealers think in generations, not decades. The next generation of car dealers is facing a period where they will need to be up for the task of not only running their family business, but growing it, which is a higher bar for most. Part of the reason for the market share gains by the largest dealer groups is due to these large groups focus on higher volume dealerships. Since 21, the top 150's average dealership revenue has risen to $83 million, 16% higher than the NADA average, and a significant increase from the $77 million that they were at in 21. By contrast, the average NADA dealership has really not changed very much in terms of its top line. In our experience, the major consolidators are very determined to own all of the highest volume stores in their respective markets, creating a step function effect in their growth trajectory with each acquisition. Okay, now that we have discussed the buyers, let's turn to the sellers, many of whom are considering an exit because valuations for most franchises remain relatively rich. The Kerrigan Blue Sky Index, a key barometer of industry franchise value, is 70% higher than 2019 levels. Sellers recognize current blue sky values for most franchises are attractive on a historical basis, albeit down 19% from their peak in 22. For many dealers, the wealth they have accumulated during the pandemic, combined with today's values, enables and in some cases accelerates their retirement plans. These sellers feel confident in selling their business, knowing their estate will be in a secure financial position based on the combination of their current cash accounts and their after-tax proceeds from a sale. Now, the decision to sell for some is being accelerated due to OEM pressure to invest in their facilities and get rid of the old and bring in the new. For many, a facility investment will not be one they see a return from in their lifetime, especially if they are at or past their retirement age. Many would rather keep the capital they have amassed during the pandemic period rather than reinvest those funds into a new building for the OEM, and this is driving the decision to sell, in our experience, in many cases. In a rapidly digitized retail environment, brick and mortar seem increasingly irrelevant to the retail experience. Dealers have long made the case that facilities, furniture, and fixture do not sell cars. The results of our dealer survey support the continuation of this perspective. Nearly 50% expect real estate and property investment requirements by the OEM to have a negative impact on dealership profits. Only 15% see an increase in profits due to real estate investing. Kerrigan Advisors finds the negative ROI associated with expensive facility upgrades is definitely a driving force for more dealers to consider a sale in the near term. And this is especially the case as average dealership rents have risen 32% since 2019, tracking to over $1 million annually for the first time. With borrowing rates still high on commercial mortgages and lending terms more stringent, especially for those smaller dealers, dealers find the economics of building new facilities waning. This is particularly true as construction costs remain elevated, with cost per square foot of commercial construction up 30% since 19. Now, while inflation is falling, the costs on building remain historically high. And this is dissuading dealers from investing in facilities, especially as profits normalize at a lower level than their pandemic peak. The challenges of expensive image upgrades are particularly pronounced in our experience for luxury franchises. Luxury dealers' rents increased at the highest rate in the industry since 2020. Today, the average rent for a luxury franchise is tracking to $1.8 million, which is, of course, 80% higher than the industry average I mentioned of $1 million, and that's up 35% from 2020. Rent per new luxury vehicle retailed is now a staggering $2,500, reflecting nearly a $1,000 increase from just 2021. Now, Kerrigan Advisors finds more of our luxury clients are choosing to sell rather than invest the millions of dollars required to convert their dealerships to the latest image. These dealers are skeptical of the benefits of additional allocation from these investments, particularly as inventory supplies rapidly expand. More luxury dealers are coming to market, driving a significant increase in luxury transactions, as you can see here, comparing the first 9 months of 24 to the full year of 23. If OEMs continue to make these infrastructure demands, Kerrigan Advisors expects more dealers will decide to sell in 25. For older dealers who have a shorter time horizon on their investment, the economic case for a new building is much less viable. Many dealers remember the financial implications of saddling a business with a high fixed expense structure during the great financial crisis. Most would prefer to limit their exposure to this risk factor, particularly if they can exit today at historically attractive valuations and retain the bumper crop of profits they attained during the pandemic. Okay, now that we've discussed expected trends for buyers and sellers this year, let's turn to franchise-specific trends and valuation. Now, the rising tide of profits during the pandemic definitely lifted all boats, and every franchise was thriving from 20 to 23. In 24, however, the tide receded, and certain franchises became exposed, with day supply ballooning and franchise profits plummeting. As Warren Buffett famously said during the financial crisis, only when the tide goes out do you discover who's been swimming naked. The Kerrigan 2024 dealer survey certainly highlighted those franchises who were well clothed and those who could use a suit. Across the board, Toyota and Lexus reigned supreme in the survey. This OEM has suited up for the EV transition very effectively, focusing on hybrids rather than full EVs, and always seems to do the right thing. Despite commanding the highest blue sky multiple in the luxury and non-luxury category, 43% of dealers still believe Toyota and Lexus valuations will continue to rise. This is likely due to the fact that the OEM has the best retail business model, with fewer franchises servicing more customers, resulting in the highest sales per franchise in the industry and the most UIOs per franchise, driving very strong fixed operations and profitability. Other notable achievements in this year's survey, and this result you see here is how do dealers expect franchises to change in value over the next 12 months, was Honda. Honda increased 14 percentage points to become the third ranking franchise for dealers expecting an improvement in valuation, just behind Toyota and Lexus. Also, Kia remained in the top 5 for franchises expected to increase in valuation. Now, mind you, they were number 1 last year, so they dropped a bit, but they're still in the top 5. However, Hyundai, which ranked number 2 last year in expectations of valuation increase, dropped to number 7, and that's the largest ranking decline in the import non-luxury segment. We expect Hyundai's drop is due to declining dealer relations with the OEM, particularly as it relates to facility requirements and the OEM's desire to consolidate their dealer network into fewer dealers owning more franchises in a specific region. In our experience, when you manipulate the buy-sell market, trying to handpick who you want to own a dealership, that does have a negative implication on franchise value. And as you can see, Hyundai franchises, currently 28% of dealers expect a decline in Hyundai's franchise value in 2025, a 12 percentage point increase from where they were last year. Of course, the most negative results in this year's survey come from Stellantis and Nissan. Stellantis ranks as the most likely brand to decline in value in 25, with 76% of respondents expecting a decline. That's up 23 percentage points from last year, and that ties Nissan with the largest increase in valuation decline expectations. Only 5% of respondents project an increase in Stellantis' valuation in 2025. Now, I should note that our dealer survey asks, it doesn't matter what dealerships you own, it asks 600 plus dealers what they think of each of these franchises. And we believe this really does reflect the overall industry view of the franchise. Kerrigan advisors also once again asked dealers about their trust levels with the OEMs. Toyota and Lexus again ranked number one, most trusted OEM by dealers for the second consecutive year. A remarkable 83% of respondents have a high level of trust in Toyota, more than triple the industry average. Honda also saw a nice improvement as inventories rebounded from last year. Honda now ranks fourth most trusted brand by dealers, a 17 percentage point increase from last year. We expect that Honda is very closely watching the Scout situation, and as they consider their partnership with Sony, may reconsider their plan on how they are going to distribute those EVs going forward. On the opposite side of the equation, Stellantis replaced Ford as the least trusted franchise. In fact, Ford saw a nice improvement in the trust level and frankly never reached the depths that Stellantis is currently hitting in this survey. Today, an astonishing 72% of dealers report zero trust in Stellantis, with just 2% reporting a high level of trust. The OEM's U.S. light vehicle sales declined 17% through the third quarter of last year, the largest decline of any OEM, and that's resulting in the highest days supply in the industry. As we see it, Stellantis has nowhere to go but up, and with the new management, we are cautiously optimistic that this could be turned around. Infiniti and Nissan also ranked very poorly on trust levels. It will be interesting to see how the merger with Honda impacts this survey next year, perhaps improving dealers' outlook for Nissan and hopefully maintaining the improved outlook for Honda. Also of note in the survey is the widening gap between Kia and Hyundai. Hyundai's high trust level was just 14%, 10% percentage points below Kia, and its no trust level was 28%, double that of Kia. Now, OEMs should be aware that there is a clearly high correlation between trust and valuation expectations. When dealers are investing in a franchise they trust, they are more willing to pay a price premium because they know the franchise value is secure. By contrast, OEMs with low trust also have a high risk of valuation decline and thus tend to command lower multiples. Now, not surprisingly, dealers are most interested in adding the franchises that they trust and are least interested in adding the franchises they don't trust. Nearly 50% of dealers surveyed would like to add a Toyota franchise, thus driving up valuation because demand is high. By contrast, only 6% of dealers are seeking VW. Even fewer, interestingly, than those looking to add Stellantis and Nissan. VW, embroiled with the Scout controversy, continues to struggle in the U.S. and abroad as the OEM loses market share in China and faces more financial problems at home with factory closures and a challenging EV strategy. It'll be interesting to see how the Scout situation plays out. Also, fewer buyers seek luxury franchises, as you can see in the luxury chart on the right, and that's mostly due to the high price point, which puts them out of reach for many dealers' acquisition budgets. But again, you see that Lexus leads that category. Now, one franchise trend in 24 that we expect to continue in 25 is dealer groups divesting of their weaker franchises. Through the third quarter, by way of example, the Publix divested of 36 franchises, a 24% increase from the full year of 23. Many of the franchises the Publix pruned were their weakest franchises. In fact, industry-wide, if we look, the franchises with the highest buy-sell market share for their respective segments in 24 were Stellantis at 32% of the domestic buy-sell market, Nissan, 20% of import non-luxury buy-sell market, and Infiniti, 13% of the import luxury market. These franchises have some of the highest days supply, reported the most significant declines in dealership profits, and have the lowest Kerrigan Advisors Blue Sky multiples for their corresponding segment. We find sellers of these franchises are frankly less price sensitive regarding the blue sky values, particularly if they are currently incurring losses. They just really want to get these franchises out of their network. Okay, that brings us to the final slides of this presentation, and that is our recently published blue sky multiples. Now, as a reminder, today, transactions are priced based on the most recent earnings in 2024 and ignore the pandemic period profits. At this juncture, Kerrigan Advisors does not see buyers incorporating pandemic earnings into their blue sky valuation assessments. In general, sellers who are seeking a valuation based on pandemic earnings are not finding buyers willing to accept those blue sky valuations. Thus, the multiples here and in our report should be applied to current trailing 12 months earnings. Now, those earnings should be adjusted for operating expenses a buyer will not incur post-closing, such as a seller's country club membership, aunts and uncles that might be on the P&L. And they also are adjusted for adding back profits that might be off balance sheet, such as F&I gross that is recorded at the reinsurance company rather than on the dealer statement. In the third quarter, Kerrigan Advisors made 2 upgrades to our luxury franchise multiples. Specifically, we increased the blue sky multiple for Lexus to a range of 8 to 9.5 times. I don't think I have to explain further why that was. There's certainly tremendous demand for the Lexus franchise given its strong position in the marketplace today. Kerrigan Advisors also upgraded JLR's blue sky multiple to a range of 7 to 8. And that really is a reflection of the demand we see for particularly the Range Rover Land Rover franchise, which saw its sales increase 28%, leading the luxury market in 24 through the third quarter. Gross profits for these vehicles are incredible, and we do find that most of the major consolidators are actively seeking to add this franchise if they don't have it, keeping in mind that there is a pretty small network for JLR, just about 200 franchises serving the entire country. So the low supply with the strong demand is definitely resulting in a strong improvement in valuation. In addition to these multiple adjustments, Kerrigan Advisors reiterated its positive outlook for Porsche and Lexus this quarter, and also its positive outlook for Toyota, Honda, Subaru, and Kia. We did not make any adjustments to our non-luxury franchise multiples last quarter. One thing of note, though, in the quarter that we talk about in our report is that for the first time since 2020, we have seen a significant rise in dealerships experiencing losses, particularly weaker franchises like Stellantis and Nissan. For underperforming dealerships, buyers are projecting potential earnings for these franchises and applying a multiple on the pro forma to determine the price they are willing to pay for blue sky, if there is a price they're willing to pay. In some cases, these franchises are selling for real estate value and almost no blue sky. Increasingly, in fact, for the weaker franchises, the blue sky values in some cases are actually lower than the levels they were before the pandemic, especially if the franchise was profitable before the pandemic and is now suffering losses. So this is by no means the rule of the industry. This is very much the exception. But for certain franchises, we are starting to see some of them trade at valuations lower than they were before the pandemic. That wraps up this webinar. I hope to see you all at NADA next week. If you have any questions on this presentation, I'm happy to answer some now, but I'm, of course, always available to speak directly by phone, my phone number is found, my cell phone number is found on our website, and my email is erin@kerriganadvisors.com. And of course, I'd be happy to connect in person at NADA if that is of interest. In the meantime, I wish everyone a successful and productive 2025.
Erin, we had a couple questions come in. Is it okay if I read them off?
Sure.
Okay, the first one is, what are some of the franchises you're seeing sell because of the facility requirements?
That's a really good question. I mentioned in my presentation luxury in particular. We have seen an uptick in Porsche franchises, and Porsche dealers considering a sale because of the expense associated with the Gen 5 facility requirements. And I think some of the Porsche dealers are falling off of they're no longer qualifying for some of the back end money because they've let their facilities not they don't have a plan for upgrading their facilities, and so that is prompting some dealers to say, rather than spend all this money, I know Porsche is a very high demand franchise and I probably can still get a nice valuation, so I think I'm going to sell rather than do the upgrade.
Got it. And we're a little bit short on time, so I'm going to read one more.
Okay.
Do underperforming dealerships sell at higher blue sky multiples?
Yeah, so in our Blue Sky report, we have those drivers of blue sky multiples. So today, if you look at the current earnings of a dealership that you might be considering acquiring, typically you would adjust those earnings, take the adjusted earnings, and then you would apply a multiple. Now that multiple goes up and down depending on those factors that we list in our Blue Sky report. And one of them is underperformance. So we're really going back to the way we did it before the pandemic when we said, okay, if a dealership's doing 1% net to sales and you can get it to 3% net to sales, you might be willing to pay, let's say, a 6 multiple on that franchise, even though it's more of a 3 multiple franchise because you think you're going to triple earnings, and then really you're going to only have paid a 2 multiple. So we are now seeing that again, that concept of for underperforming stores, especially strong franchises, we are starting to see dealers consider a premium multiple if they feel confident they can turn the store around quite quickly, and it's a franchise that is very strategic to them.
Got it. Well, Erin, thank you so much for joining us today. I look forward to seeing you next week at NADA and anyone else who will be there. Again, you'll all be receiving a copy of this presentation by the end of next week. We take a little break, but we'll see you all back here in March when we kick off our spring series, so be on the lookout for promotions. For more information about AIADA, visit aiada.org. Have a great day, everyone.